The big voice which we managed to get on the channel after a very long time, Nomura's Prabhat Awasthi. I chatted with him about RBI policy stance, markets, macros and sectors to bet on. Here's an exclusive slice.
So I think it is obviously from India perspective, growth is quite important because we still have sort of long innings to go. We are not a developed economy. We need to continue to grow to lift our population to a better living standard. So I think that is very imperative. And I think also coming on the back of the fact that if you look at last few years, the growth was very, very anemic. We have essentially put our house in order in the last few years. We have cleaned the banks. We have sort of gotten rid of our NPAs. Several sectors have gotten reformed. We have done very, very massive reforms. But it was at the expense of growth to some extent. And I think the challenge essentially for the government is to how to lift that growth. And the fact is that while the corporate balance sheets are good, the investment cycle is still not recovered, at least the private capex cycle. So I think it is important. The only challenge essentially is that while RBI has not raised rates, the long end bonds have already sort of sold off quite a lot, right? So the fact is that cost of borrowing in the system have not really has sort of anticipated in some sense rising interest rates. But I do think that both government and RBI seem to be prioritizing growth at this point in time. Inflation is an issue, but it's less of an issue in India compared to other developed economies. In fact, US inflation is higher than India. And to that extent, you'd say that the real rates in India are higher, much higher than in developed world in some sense. So maybe they, in their sort of mind, they think that there's some room for them to continue to, remain sort of accommodative.
Right. Prabhat, we are also having this chat now at the point in the phase of the market where we've had two surprisingly good years. I mean, who would have thought from the depths of the pandemic, market would give such solid returns thanks to the global liquidity gush. But that liquidity will now start to ebb around, and bulk of the positives perhaps are also in the price. For equity markets globally and India, how are the odds stacked on returns from here on? What are the parameters on which things will be based from here on?
So, market is just two things, right? Sum of earnings and earnings multiple. So you multiply earnings multiple that you want to give to the earnings and you get the market level. And essentially, if you look at last few years again, we didn't have earnings growth. We actually had multiples because the monetary environment globally, as well as in India, was so supportive that we essentially got a multiple expansion process going. And as a result, the markets actually returned better than what was expected when the pandemic started. But obviously there is part to it also that the earnings didn't collapse as much as expected. Also, the economy in fact has pretty much recovered from the sort of bottom it has hit a couple of times, but the overall economic activity is good. So essentially, between the normalization of economic activity and therefore of earnings and the loose monetary policy and therefore multiples, you essentially got a very good market. The question essentially is that what about earnings growth? Earnings growth, I think, is still pretty solid. I mean, it's obviously recovering very strongly in fiscal 22, but I think in 23, 24 also the expectation is that you'll get about 17-18% on an average, maybe 17%. So I would think that you will get some returns, but there is a good likelihood. There's a likelihood that there might be some contraction in multiples simply because the inflation, if it doesn't come under control and interest rates rise very rapidly, for example, US, then you could still have a situation where the multiples might contract. But you must remember that the earnings are growing at 17%. So if the market remains here, it'll be cheaper by 17% in a year's time, which will put it on a long-term average of 5 years. So it's not looking expensive. So therefore, I think that it's not an easy one, simply because of the fact that what will take, how much interest rate rise will have to happen before inflation comes under control is not an easy question to answer. But some expectations are built in, so markets must have sort of factored in some interest rate increases already as we speak today. Their markets are lower than where they peaked. We have had some time lapse, and the earnings growth is still happening. So I think I would think that on the balance, from current levels, you should get some returns. The risk in India, I think, is there is a risk in India, and I think that comes from external sector, because remember that we are running a very large trade deficit now, and our BOP is no longer as supportive as it used to be. We're going to bleed some liquidity going forward, and if the growth picks up, then I think the trade deficit will become a bit of a problem for India. We have not had this fragile sort of balance of payment for a long, long time. We had in 13, and we remember what happened to currency and market at that point in time. So that I think is clear risk, and that needs to be clearly watched as we go forward.
Right. Prabhat, I'm also curious to know your view, because you would have a very good handle on the FIS sentiment representing one such organization, and of course your peers. The way selling has been relentless for Indian equities, where do you see it go from here on, and how long? Because FII as a community is a very large holder of Indian equity for a very long time, and the selling has been relentless. One may take heart from the fact that it's getting absorbed so far by retail, but what if that confidence is shaken? Indian equities can come severely under pressure, is it not?
I absolutely agree, and I think there is no good answer, frankly, telling the truth. If you were standing 6 months earlier and asking people, will FIs continue to buy, they probably would have given you an answer that yes, they will. And you ended up essentially in a situation where you have seen 80,000 crores or something like, selling by FIs. And I think it's largely because of the fact that, obviously the macro cycle globally has shifted a lot. And India was a market which had seen disproportionate share of flows because it was the market which is growing better than others. Other markets have become slightly cheaper, other emerging markets. I think that is one thing which is not in our favor. And the fact is that, as you rightly said, so I think it's not an easy one. And the other risk, as I said, on that is that domestic liquidity will probably start to wane. Because a lot of domestic liquidity infusion is happening through BOP surpluses, and that has shifted. So our forex reserves are slowly starting to fall a bit. So I would think that it's a risk, and it can, therefore, markets volatility will probably can increase going forward. It probably is, in the whole of next year. This year we had relatively stable markets one way. I think it'll be more volatility will be probably higher, despite the fact that I still do think that you'll get positive returns. But harder to predict given the fact that the Fed, the US inflation is still running very hot. And therefore, the view on the interest rate cycle is still not fully formed, though I think, people are expecting rates to go up, and how and total extent of it will only be known as you sort of go through the year. And as I said, Indian liquidity starts to come down at some point in time. So more volatility and there less absorption capacity. So one has to be careful, but I still do think, as I said, that you might be able to eke out positive returns.
Prabhat, what's your call on the entire commodity inflation part of the equation? What is your house call, your peers in the macro side, or your commodity team? Where do you see it peak? RBI governor is assuming and estimating the peak of commodity inflation perhaps in Q4 or Q1 of the next year. What are your thoughts?
So I think, again, very hard to predict commodities, right? It is one of the things that, I used to be commodities analyst long ago in my career, and I know that nobody got it right, first of all, right? So, oil has seen 60, has seen 90, and people have very different views at 90 and they have different views at 60. So, they're opposite of what it should be. But, well, the good news is that commodity prices have been stable for a bit now, right? So they had a big rally, partly because of the supply bottlenecks, partly because of the recovery in growth, and many factors. But the fact is that commodity prices have risen a lot in the last 2 years, but of late at least they've sort of stabilized, with the exception of oil, which is a negative for India. But in general, commodity prices sort of flatline. And inflation is always a year-on-year thing, because once you sort of seen that number by the time next year, so momentum in commodity inflation is obviously come down, and inflation tends to follow. Commodity inflation tends to follow with a lag, simply because when the raw material prices go up, the pass on happens with a lag. So you see the impact in the economy of that inflation, the 3-month lag, that's when your raw material prices go up. But if the commodity momentum is sort of breaking down or sort of flatlining, then it's a good sort of guess that even the underlying inflation momentum will start to wane at some point in time, right? The question essentially is that the only inflation that's happening? Because you've got other things happening. For example, job markets, they are very, very hot, right? We've got the rupee depreciation that could come through, and that could import inflation in the country. So I think fundamentally the only thing that I sort of worry about is that whatever the commodity prices were doing all this last 10, 12 years, we didn't have the kind of job inflation that we are seeing now globally. And last time we saw a big inflation wave was essentially when all the jobs, so I think, so my question is, and that there's no good answer to this, but I think more fundamental measure of inflation, what they'll do going forward, is very difficult to say. But I do think that what RBI is sort of saying at this point in time might actually come to pass, simply because of the fact that if you go back in the last 4 or 5 months, commodity prices sort of have been hovering around the same levels.
Prabhat, let's step into the sectoral arena then. What is your stand on global sectors, export-oriented sectors, be it pharma, IT? IT has been doing phenomenally well last 2 years. How do valuation versus growth metrics look over there? Global cyclicals?
So I think our general, at least equity market strategy view is this, that we do think that in the last few months, let's say, there have been some headwind to growth even in India on a sequential basis. The data has become a bit weaker, right? Because if you look at steel consumption, cement consumption, automobile sales, rural facing economy has been a bit weaker. While the budget pushes the growth a bit, but if you were to take out things like IBR, etc., then the growth on capex doesn't look so strong as it looked in the first reading. So the question essentially is that the growth momentum is, well, there is a growth recovery, but it has weakened a bit. Now, it could partly be because of the fact that we had a pandemic resurgence, and the contract economy obviously had slowed down, so you could see a recovery back. But our general sense is that we sort of, well, so our strategy view was that if the growth remains here, I mean, it doesn't recover strongly, then it pays to be slightly defensive because valuations were slightly higher. So we were actually, our strategy, especially Shine, was thinking that you should be bullish on IT and pharma, but not so much on metals because the prices were already sort of up there. So largely, defensive sort of strategy was what we were going with, even though I think to some extent, if you look at from where we published to now, the markets have come off a bit, sort of played out to some extent because the report was published slightly earlier.